Have you ever wanted to invest more effectively? Well, my name is Nick Drips, and I'm a financial and organizational management major. And today I'm going to tell you how to do just that by going over portfolio risk measure. A lot of this information you can find in my text, which is Investors Analysis and Portfolio Management, 11th edition, and Essentials in Investment. And if you want to do some of your research on your own without buying the text, you can just go to investor.gov to find a lot of this information to help you invest. So basically, portfolio risk measure is just a way to calculate uncertainty on your investments. Every investment has a degree of risk, potential of loss of your returns. And of course, we want to make more money. So we would like to avoid risk. So today I'll be talking about portfolio risk measure, and it's two types. So we have unadjusted risk measure and adjusted measure. Unadjusted risk measure is also known as the variance measure. So when you're trying to decide stock to invest in, it has a few probabilities of risk. So I worked out this example, basically determining stock, whether like the probability of it being good, bad, or a normal economy. So I have those written out here under PI, and then I also have the returns of each economic condition. So we got 20%, negative 20%, and 0.1 for good, bad, and normal. So basically, when you're doing variance measure, you need to find your expected returns on your investment. So determining the state of the economy, basically, we follow this formula for expected returns. So you multiply the probability times the expected return, and you sum them basically through a summation. So here we got 0.15 and 0.2, it's 0.3, negative 0.2 and 0.15, negative 0.3. So that cancels out, that's 0. So we're left with 0.7 times 0.1, which is 0.7. So if you sum them up, 0 and 0.7, your expected return for your investment, depending on, no matter what state it's in, it's going to be 0.7 or 0.07, sorry. Once you have your expected returns, basically you can do the variance measure, which is basically taking your probability, the expected return in that economic state minus your expected return, and squaring that. So as you can see here, for the good economy, we've got our probability of the return minus the expected return squared. We get this, do the same thing again for the bad, and then the normal economy. And then following our variance equation, the summation of that equals 0.0141. So basically, that's our variation. And once you have that, you can calculate standard deviation. So variation is sigma squared. So if standard deviation is just sigma, then all we have to do is square root our total. Doing so, we get 0.1187, which is equivalent to 11.87%. So what does that mean? Basically, that's a fairly low percentage. As if you don't remember, we calculated our expected return, which was 0.07. So basically, depending on what the state of the economy is at 0.07, it is only going to vary 11.87% from the mean. So the mean is basically our expected return, and it's only going to vary within 11% of that, basically. So if you want a 7% return, it's a fairly safe investment. It's not going to vary that much. So once you have that, you can make a more informed decision on your investment. But if you're looking to make one that's even more accurate, that's when we use adjusted measure, which is the coefficient of variation. So using our last example, we had 11.87%. So you're feeling like that's a relatively safe. If you want to go a step further to find our coefficient of variation, it's our standard deviation divided by our expected return, which is 0.1187 divided by 0.07 equals 1.696 for coefficient of variation. To put that into perspective, we can use this adjusted measure to compare other investments. Now that we've found one, we can better decide which investment is better for our money. So basically, for another example, once we have these numbers, let's say I wanted to invest in A or B. I want to invest in computers or planes. They have different returns, and they also have different deviation from their good and bad economy states. So as you can see here, investment A's got 0.07 for expected return versus 0.12 for B. So, I mean, right off the bat, you'd think, oh, I want to invest with B because it has a higher expected return. So using our unadjusted risk measure, we get our standard deviation, which is 0.05 for A and then 0.07 for B. So using our unadjusted risk measure, we would think that A would be the better investment because it has a lower deviation. So going back to this example, so if it has a lower deviation than investment B, it's not going to vary as much from their expected return. But using the coefficient of variation, it's investment B has a better coefficient. So basically, depending on what measure you're using, it can influence your investment decision. So when you're using the coefficient of variation, you get a 0.583 versus 0.714, which is lower than investment A. So you would in turn switch your decision to investment B because it has the lowest risk per unit due to the higher expected return. So yeah, that is portfolio risk and its measures: unadjusted risk measure, variance measure, and the coefficient of variation adjusted risk measure, and how to use them. So now that you've learned that, you can make better investments decisions and make some more money. Thanks for listening.